Welcome to Preserving Your Wealth with Mike McCormick, where we talk about smart ways to invest and preserve your money. Mike is a registered investment advisor with McCormick Financial Advisors in Bozeman, Montana. As an independent fiduciary, Mike does not receive commissions from any of the products or investments mentioned on this program. Consult a professional before making any investment decision. You can find old shows archived at McCormickFinancialadvisors.com. Learn, participate, interact.
And the aforementioned Mike McCormick is in the house this morning. Welcome, Mike. How you doing?
I'm doing excellent. Happy December time.
Yeah, Merry Christmas to you. Shane's on the line with us, of course.
Good morning, Michael. Merry Christmas to you and your family.
Merry Christmas, Shane. Across the border, it is. It's on, right? It's dark. It's cold. And we got the spiders up downtown. There's incredible festive holiday cheer here in the studio. You can't see it, but I had to wade my way in the door here.
I know.
The tinsel is
the Christmas
stuck
Christmas
in my mustache.
Yeah, this is pretty
Yeah,
close.
it's Tom's Christmas DACA.
Yeah, right.
It's extreme Christmas here.
That's very true. Very, very true.
And Christmas is coming for the markets. I mean, who thought 2019 was going to be this strong?
No, 28,000.
I don't think anybody's raising their hand.
No.
I mean, I do remember I was a glass half full kind of guy.
Were we talking about recession like 6 months ago?
Not this guy. I was talking about breakfast bets, as I recall.
That's right.
But I don't gloat, and the year's not over yet. Now, we remember last year.
Last year it tanked.
It tanked. Christmas Eve was awful.
Yeah.
It was comedy, really. And we might have that again, right?
Yeah.
That's the new normal, is that when you least expect it, and things don't happen for logical reasons.
Yeah.
We come on afterwards and we try and find logical reasons why what happened made sense. But yeah, right now people say everything's honky-dory except for everything's expensive.
Yeah. That's
kind of like the economy in a nutshell, right? Everybody's got money, we're going to spend, and we're going to buy things that are too expensive. Cell phones now, $1,000 a pop.
Yeah.
Not saying they're not worth it. They're ubiquitous. They're needed. You got to have one to function. But $1,000 consumer item, whoo! I mean, TVs have gone down to $300. Cell phones haven't quite done that yet.
Yeah, no, they're still rocking and rolling along. Just an FYI, Nancy Pelosi's talking right now about the justification for impeachment of the president, and she's claiming we need to address the president's failure to execute the law. So there you are. So
right,
which has nothing to do with what we're talking about here
impeachment,
today.
Brexit, Hong Kong. These are things that
it never ends.
These are things that are real issues, but they're not really affecting the economy.
Yeah,
that's kind of the gist, right? I mean, they're real issues, they're problems, but they're not currently anyway factoring into what our listeners should be doing with their savings or their business procedures.
Yeah. From our text line, 478-8298, does Mike expect a correction before year end? Ooh, that's a tough one.
Yes, but it depends on what you define a correction as.
Wipe off your crystal ball, yeah.
Right, I mean, we're overvalued.
Yeah.
Things are expensive. And the way that they're going to get back to fair valuation, and we'll never, the average is fair valuation, and we'll never get the average, so we'll go swing too far, is either two things. One, time. Over time, earnings should continue to improve, and valuations should get more reasonable, right? If you're making more money, then the cost of your rent or your car or your cell phone or whatever, it goes down. So that's the preferable way, right? We all want to make more money. It'd be nice to get things on sale. But then the other way is the more traditional way of, oh my God, there was a secret signal given to everybody in the know to sell all your stocks yesterday because today things are plummeting. In this world, I'm very focused on the correlations of everything. There's no place to hide other than cash or some sort of sophisticated esoteric things. That yes, we will be exposed to a pullback, but we've been talking about it, and it's when you least expect it. So if we're all expecting it, it's not going to happen. What's the trigger going to be? If I don't know. I mean, if it's not trade negotiations breaking down, or a bad Brexit vote, or an impeachment process, which again haven't been moving the needle, It's something that we don't know. And are there bubbles being formed that are similar to the Great Recession's trigger last time in mortgages? Yeah. I relate it to this economy here in Bozeman, where the housing situation is completely out of hand. The prices are very high. The justification that buyers are using to plug their nose and buy are contrived. The idea that their rents are going to be able to sustain an income level for a cap rate of 4% or 3%, that's not sound investing principles. The idea that depreciation on an asset is a reasonable investment thesis, that because there's tax savings that you'll have to recoup later, isn't reasonable. And we're seeing big money show up and buying big apartment buildings and REIT money and things like that. So we're very mature. Well, the situation is that everybody that's involved in the construction of these new things right now, from the realtor to the developer to the people pouring concrete curbs to the people that are wiring the houses and cleaning them before they're ready to go, their prices are all high right now because they need to be, because it's expensive to live. So the fragility of the system is increased by the lack of elasticity, meaning that not everybody we can't deal with a 20% cut because it's not just cutting out the developer's profit period and everybody else is still okay. We've gotten used to this. We are boiling over. So any correction will hurt. It will surprise. The game plan that I recommend is the same one, which is you need to take your retirement money seriously and continue to keep it at growth. You need to keep it at risk. If you wouldn't have done that this year, you would have missed out on some fantastic gains. The average diversified aggressive portfolio is 14% plus for the year. Some portfolios that are heavy in tech and light and international or oil are doing better than that. You don't know when you're going to get these years. So for the long money, you have to keep it at risk. But, boy, it's a great time to be looking at a 2% CD at your local bank and saying, boy, I want to have $50,000 in Monopoly money to play.
Yeah.
And I don't expect a big pullback. I don't expect any significant buy things. But I just, if on average, are we above average price? Yes.
Yeah. Well, the other thing to think about, too, if you're going to talk about real estate, is that the real estate price is going up and up and up. That affects renters because your rent's based on what you got to pay for that rental property.
Yep.
And you talk about depreciation as well, and many times renters don't always take care of the property as well as, the owner would. So
many times,
as we all know,
everybody that's investing in real estate right now absolutely loves it. You're not going to convince them anything otherwise because it's doing great.
Yeah. Well, and also too, there's thinking that the rates are going to go down over the next 5 years or so.
I'm not thinking that.
You don't think so?
No.
All right. Well,
no.
We'll see.
I think we're going to see rates stagnant for a while.
Yeah.
And I don't think that we're going to see.
You don't think you're going to see below 4%, huh?
No.
You don't think so?
No.
Okay.
No.
But you have to realize that 5 or 6% of let's assume that this continues. $300,000 houses now are going to be 5.
Well, everything's going to go up, right?
Yeah,
I mean, the price of candy bar used to be $0.25.
But that's why I'm thinking the rates will go down below 4, because on 500,000,
you got to make more money.
Yeah.
You can't just make it cheaper. That's not how prices don't go up by making money. It does happen, but no. Jay Powell's pretty clear on the Fed. He thinks things are fantastic. He's not telling people what he's doing in the future. We've got infrastructure problems. We've got there are real problems. Of course, there's income inequality. But right now, it is Christmas time, and we've got some year-end tax tips for the small business owners I want to go over today. I've also got a few tips that I want to go over for planning for caring for your elderly, how you handle their accounts. But I do always appreciate these phone calls. It's year-end. There's a few things that you can do. And more importantly, you got to plan ahead. I mean, right now, I am already expecting, the Christmas bills to be coming in. And then I'm expecting that it's going to be January, February, where I need to be looking at making my profit-sharing contribution to my retirement plan. Mm-hmm. Well, that takes a lot of free capital. That's about the same time the credit card bills come rolling in.
Yep.
So you need to be looking forward and sort of, and then, of course, we've got some vehicles that are getting elderly. And so there's things that we need to plan for as we come into this. And then there's spring break planning, Tom.
Mm-hmm.
You know, you got to jump on a plane and get warm.
Go somewhere,
It's just like a rite of passage for the typical yuppie family here.
Shane keeps me warm here.
Oh, God.
Oh, yeah. At a distance.
Yes, he does.
Shane, did you have a good Thanksgiving?
Oh, yes. October is a wonderful month to have Thanksgiving, you know.
Yes, I know.
We get the first pick on turkeys.
Yeah.
Yeah.
I like it. That is well said.
Yeah. From our text line, 478-8298, does Mike think the Fed will be pressured by the president to lower rates, and will Powell buckle on that? We've talked about that the
What's
president
the expression,
would
Powell buckle?
really, the president,
Yeah, right.
lower rates.
Oh, sure. No, I got that. I was missing the expression at the end. No, it's a great time for Jay Powell to express his independence, and I think that Donald Trump knows that. I think the president just knows that this is a fun little narrative that he's going to have. There's no way that it's going to be any way. And now, if we have a Christmas Eve pullback and things get scary, sure, we might lower rates, but not because of one thing that anybody told Jay Powell to do. No.
Yeah. Well,
The last
go ahead,
meeting is
Jane.
on Monday.
Sorry.
I'm sorry.
Go ahead, Jane.
Well, the last Fed meeting for this year is on Monday, Tuesday, the 10th and 11th, when the Horowitz report comes out and the Senate committee starts their hearings. So that might be interesting.
And we also have tariffs going into effect on the 15th if nothing is done, or if they don't postpone those till after the first of the year.
Exactly. And so we're watching, Powell's doing something that the other Feds have done too, which is, Yellen really started this, is if the markets are screaming for it and threatening to go down even more, there might be a cut. But there's not a lot of room, and the economy is pretty darn healthy. So, it's kind of like cold and flu season, right? If you're a daily emergency taker, I think you should probably take a week off when you're feeling healthy and let your immune system catch up and get healthy. But this is the time for us to just be healthy.
Well, I think the president wants a cut because that could boost the GDP up to 3% or above 3%. It's about 2-something now, I think.
No, it just help people stay happy and be making money and make it. Certainly, the stock market would go up if there was a cut.
Oh yeah, no question. Yeah, right now. Let's see. Let me go back.
I think that it's equal. I mean, at some point he's going to raise rates again. I would think. I'd think it's almost equal if it goes up. But in the end, I think no, it's off the table. Nobody's focused on the Fed right now. Nobody's expecting any changes out of the Fed. People are focused on, corporate earnings. Yes, they're focused on Hong Kong. But really, it's just one of those times where, there's some big money moving around. It's year end. Active management, if you want to talk about what the big boys in Wall Street are doing, right? Hedge funds are closing with incredible frequency. This is a terrible time to be an active stock picker. Only 20% of the U.S. stocks have outperformed the S&P. So that means that if you were picking stocks versus having an index fund,
you had an 80% chance of losing.
You've got an 80% chance of losing.
Yeah.
And if you're paying somebody to pick stocks for you, an advisor picking individual stocks or an actively managed mutual fund, you've got an 80% chance of losing there too. This narrative is something we've covered. You can use exchange-traded funds to index invest. I think there is a reason to be intelligent about not just putting it in there. But, boy, if you're in a 401k and their target date fund, don't touch that wheel, man. That has been working for you.
All right. We got to take a quick break. We'll be back with Mike McCormick right after these important words. Stay tuned. So much for the stations that won't play, baby, it's cold outside. We are not one of them. Mike McCormick is in the house. Shema Taubman, half man, half amazing on the line. Tommy, go off your morning, Mayor.
I would like to get a bit glass half empty, though.
Okay.
Can I?
Sure.
Because things have been so good for so long, there's complacency in a lot of areas, and that's primarily wound up in this bond market. And so if there were a surprise, everybody woke up and actually things are bad and we're in trouble, I think it would probably be related to the ability that companies have had to issue debt recently for the past few years. And, they're doing things like buying back stock, but they're able to issue it at really low rates. They're getting big stamps on their ratings and their levels. And then if we were to see that Christmas somehow weakened them or tariffs weakened them or X weakened them, these companies would be downgraded, their debt would be downgraded, and then as the tide goes out, we'd see who's not wearing any shorts. And there could be a problem there, and that problem is really focused at people that are looking for safe investing. If you are a conservative investor, you look to bonds, and that's also tied in with this rate situation too. So there is reason to be concerned that this will end in a way that, yes, it will impact everybody dramatically throughout the whole economy, and that would happen through the debt market, in my mind. And Shane, I'm interested in your feedback on where you see, I think that there's glitter on everything right now, but underneath it all, are we just dealing with trees that are dying, I guess would be the euphemism?
Yeah. Something like that anyway.
Right.
In breaking news, House Speaker Representative Nancy Pelosi of California said in a Thursday morning press conference that she is asking House Judiciary Chairman Representative Jerry Nadler to draft articles of impeachment against Donald Trump. So,
there you go.
Getting her Christmas shopping done, isn't she?
That's it.
You got to get that in the mail, I guess.
I don't know what these people are thinking, but
yeah, I don't know. But you know what I do know? I can watch commercials right now and not watch any election ads at all.
Ooh.
Right? Let's embrace that. Let's watch some commercials right now. They're really pretty good.
Yeah.
If you happen to be not in the Netflix world or stuck in a cable show or something like that.
I know, yeah.
They've gotten back to being clever again. Hey, can I talk a little bit about the legacy estate, taking care of old people?
You can talk about that for
okay?
another 4 minutes.
I can do this in 4 minutes.
Actually, about 2 minutes, but
I don't know if I can do it in 2 minutes.
Well, we'll start it. We'll come back after the break.
Here's the situation.
Right.
Your parents are getting older. They are recognizing that they're mentally not as acute as they once were, and they're also going to the incredibly large step, the next step of saying, at some point, I probably don't want to be dealing with my own money, and that would be the way that they should phrase it. Not I shouldn't be, but I probably don't want to be. And so I need somebody set up to make decisions for me, to make my life easier, to make these decisions be better. And there's tools already in place in this world that help people do that. And there's a lot of different ways to go. The most robust way is to go consult an attorney and that the family respects and get everybody in on it and talk about the whole estate and what the whole plan is. But there's simple tools that are already there, and power of attorney is really one of the ones that in my business, in the world of investing, that's already set up and ready for you. And I think people should recognize there's two important things about this power of attorney that people need to know. One is there's different levels of it, and the levels of permission that your agent you assign has different permissions. And my advice is go for the maximum level of permissions. Don't go with a watered-down version of it. If you're already having this discussion, don't just plan for the next 10 years, plan for the next all the way to the end years. And so the brokerage houses, Schwab, whoever, they've got these forms there. You can check boxes for every account, and you need to get it all notarized for everybody that's signing their powers over and everybody that's assuming the powers, but you can have multiple kids on them. And these things are already all there. And so just don't delay. And then the second point that I have is that if you read articles about how to do this, they always say, well, initiate the conversation, get the conversation going before somebody gets to be impaired or old. And while that's sound advice, it's not practical, because if you go to your healthy parents and start talking to them about the day that they're going to become too old to make decisions for themselves, that's just not for us to bring up. It's rare that they're going to say, you're right. I'm going to die, and I might have, dementia before I die, and all these sad, horrible things that I don't want to believe is going to happen. Just be delicate on that one. I've seen a lot of these conversations and coming to Jesus conversations just not go how they should. So walk delicately. This is holiday time. Keep a smiley face on it. In terms of talking about it with your parents, I don't have any real advice, but be gentle. Nobody wants to be talking about their own mortality, much less running out of money or not being able to make their own decisions. So that's my 2 cents on the estate planning. And I'm interested that probably a lot of listeners have some really great feedback about that too for everybody. So,
okay. Well, we've got a couple questions coming in from the text line that we'll want to answer after the break. So,
great.
Folks are active this morning.
The
I
text
guess.
line is hot.
Yeah, we're working on it. Shane Matobin, half man, half amazing's in Vancouver, British Columbia. Tom Eagle off your morning mayor. Mike McCormick, how they get hold of you, son? Mike McCormick, advisors, financial
You can
advisors.
spell it however you want on the interweb. I think my searches are doing pretty well. Love to hear from you. Everybody gets a free consult. So, yeah, I'm here for financial literacy and to do what I can to help people.
Phone number?
522-3890.
All right.
Hope you wrote that down.
Yeah. If not, we'll give it again. We'll be right back with more with Mike and Tom and Shane right after this. Stay tuned. It's 24 minutes for the top of the hour. It's Thursday, December 5th, 2019. Mike McCormick Financial Advisors, is in the house, and we've got some text line questions for you. Mike, I've been receiving information from investment news sources that say U.S. banks are in trouble. They say the Fed has issued a clandestine emergency $120 billion per day bailout to save the failing money market system. They claim U.S. banks are pledging mortgage securities and treasuries as collateral. Sounds like background noise, more BS maybe? What have you gentlemen heard? Heard anything about that, Mike?
Yeah, not specifically, and I'm interested to change the feedback, but when you do take a money market fund and you peel it back, and I just did this the other day, so you can find a 2% money market fund or maybe more, and you peel it back, it's not just U.S. treasuries they're holding. They're holding secured collateralized debt from other organizations and overnight deposits and things like that. So, yes, it parlays to what I said earlier about our debt situation in this country might be an Achilles heel. As people get more comfortable, we don't realize what the temperature of the water's at, maybe would be the euphemism, right? And so all across the board, everybody loaning money to each other and feeling like everybody's really healthy. And then one day we realize that everybody's got an STD, is the euphemism, the crass euphemism that we had in our previous Great Recession. To some small degree, that might be going on, our complacency, comfortableness. But no, in terms of the material you've been getting, they are selling you something. So I would be cautious.
Okay. Shane, any thoughts on the banking situation?
You bet. I'll give you my 1 minute run over. I had some concern because fundamentals we're looking at, the New York Composite Index fell, as we all know, on Monday to a low of 1330.45, and then bounced back on the 3rd to 1347. So that was a 10% drop. That sort of came about because of four reasons. First, because of global debt. The problem that you have with that was Italy's debt went up, and their debt rate went. The interest rate went to 1.4%. But global debt now is so large and so significant. It's over $100 trillion now, and the IMF is warning about it. Corporate debt's over $29 trillion. The global annuity market is heading towards $4 trillion. And the big one is the U.S. bank debt on oil, the oil industry, which is at $169 billion. And they're all losing money on fracking oil and gas. We've talked about that. But the sell-off on Monday is because Christmas falls on a Wednesday, so does New Year's. So the banking industry will be on holiday from the, the 20th of December till the 7th of January. And with that, combined issue of the election in England, although the pound sterling's recovering because they expect a conservative majority, there's just fundamental concerns that anything could happen and trip probably a correction like Mike has talked about, but it could lead to a bigger correction than we may want. But it'll be a great time, as Michael has said, that's when you look, hold on to cash and be prepared to buy what you love.
Okay. The other thing too, Mike, we have the shortest Christmas since 2013. Of course, since the last Thursday is not the.
I know. I'm freaking
Thursday,
out already.
It's the fourth Thursday.
I'm freaking out.
You got fewer days to shop.
Right. I got to get my gifts out, write the cards.
That's right.
What's your ad? I got to send the text messages out. What's your address?
Yeah.
What's your address?
Yeah. But we did have a record-setting Black Friday and a record-setting Cyber Monday. So it would appear that people have money. It would appear that the tariffs aren't hurting the shopping season all that much. So, or else people are just saying, okay, that's what it is. I'm getting it.
It's a great time to be in 2% CDs and dividend yielding value stocks.
Yeah.
And with a toe in the water for the risky stuff, for sure. The big companies are going to still be bigger. But there's another good text question, I think, that parlays well on that other one, too, Tom.
Well, the GDP, the other question from our texters at 4788298, GDP is only 2%. Is that the new norm, or will there be an increase in the GDP? And we were commenting off air that, we're not talking about 2% of 10 trillion. We're talking about 2% of 20 trillion.
And so I'm not current with what today's GDP print is and what we're looking at, but I think it's more than 2 on an annualized basis. But
we are at, I'll tell you.
You'll be my numbers guy. I'll be the color commentary guy, right?
I'll tell you exactly what it is.
So we're in a low growth environment.
We're at 2.8 as of December 4th.
Right.
2.8% GDP growth.
We're in a low growth environment. We're in a low inflation environment, and we're in a low interest rate environment. So those all are related directly, and they're all consistent, and they've been relatively consistent. So I'm not too concerned. I think the reality is that we can't have 15% portfolio growth for people investing money and doing nothing. I mean, that's the magic of this, too. One is that you don't have to do anything and your money grows. Number two is that, it's liquid, transparent, and somewhat tax efficient. So that's not normal. You can't have 2% or 2.8% or whatever you want to call it growth and have a 15% growth in your stock portfolio over the long term. There's a disconnect there. So the big number is GDP. You can't just make stuff out of nothing. And if we don't bring GDP up through productivity or population growth, we are going to be France and be striking in the streets within a decade.
Yeah,
which is a little womp, but that's kind of one of the realities that I think we're looking at.
We've got to take a break. Shane has a thought after this short message. So, Shane, hold that thought, and we'll be right back right after this. Hang on. Mike McCormick in the house. It's Thursday, December 5th. Let me tone down the Saturday night guys, if I can. They don't want to tone down. There we go.
It's the best classic rock show on talk radio. I tell you that.
Man. That's us. That's for sure. The best of the best. Shane had a thought as we were leaving for the break. So, Shane, you're on, man.
Well, yesterday was Walt Disney's birthday. So, in honor of Walt Disney, who I'm sure is looking down and very happy. Disney. Wow. They say they've signed up 10 million already, new subscribers for streaming. The street says 30 million. So let's cut it in half at 20 million. Well, they also own Hula, 28.5. So that's 48.5 million. They also own ESPN, which is 3.5 million. So you're looking at 52 million subscribers to the Disney streaming. And let's remember the big competitor is Netflix, 158 million worldwide since 2007 and 60.6 million in the U.S. Disney will pass Netflix in the U.S. and may hit 100 million, I believe, by Christmas. Go Disney. This is great. Their stock price is showing and reflecting that at 148. Dismal dividend, though, only 1.2%. But this is going to be a real game changer. We got to watch this stock over the next 6 months because an entire industry is going to change because of it.
Could be very, very true.
It could be, and there could be room for both Netflix and Disney too, right? As we all cut the cable and watch more things on our devices. I'm not saying I'm totally with Shane. Shane's very savvy on these things. Disney's the better bet right now, but who's to say?
Particularly with their introductory price, I think, is really bringing the people around because they've even reduced it to $50 a year, I think, something like that. They did have 147, Shane, I think, for 3 years or something like that. You get a year
That's
free,
right.
Something like that. So, it was.
And then you get Hula, ESPN, so you get all the sports, and then you get Disney, and you get 21st Century Fox library. So huge.
Yeah, it's a big deal there. So.
And you get National Geographic and 4 or 5 other small channels that Disney has bought that you would normally pay on cable. So for those of you out there on a budget, particularly retired folks, go to Disney Plus. It just saves you a huge amount of money, and you can watch lots of television.
Yeah. All right, from our text line, 478-8298, Mike, if Trump were impeached and removed, would a President Pence bring more stability or vitality to the market?
Velociraptor?
Yeah, velociraptors to the market.
Oh, gosh. So that, of course, is the big market disruption, is if we're looking at a change in country leadership that would go socialist, and not to Pence, but that could potentially go socialist, because that's how this narrative goes, is that if impeachment happened and Pence were there, then Pence versus whoever. Yeah. Now, I think that a Pence has an opportunity to be more of a centrist that might have, in some ways, more electability than Trump, who's polarizing. But this is not my field. This is your field, Tom. So the basic game plan that I'm playing is that impeach or not impeach, Trump will be sitting in the White House during the election that's happening next November, and that will be a risky moment. Also, people are saying whatever it takes to get elected. That's normal. And if they're saying things that are counter to us keeping our money and making our money, they probably won't be elected, because at the end of the day, people are going to vote with their pocketbooks. They might mobilize a lot of people that have smaller pocketbooks to come out and vote. In the past, that hasn't been enough to tip the scales. So I try and placate people that are nervous about that. But yes, there will be scary moments between now and tomorrow, and they will probably be related to these sorts of scenarios. I think a Pence, if Trump was to be removed, the stock market would take a hit. Period. Yeah, I think so. Let's hope that no matter who's president, if there's an impeachment, that the stock market would react, right? That's sort of a bad sign. Sure, yeah. Well, the other thing, too, that almost every Democrat running is talking about rolling back the tax cuts, rolling back things that won't make you more money is what they're talking about. Exactly right, yeah. And that's a narrative that I think that they're not going to win on. But so we'll see how that goes. Yeah, I don't know. Pence against, Biden. I don't know. I mean, that's a lot of vanilla yogurt, a lot more iffy plain yogurt. It would be a lot more iffy than Pence against Trump, Biden against Trump, obviously. Yeah. Well, again, that's your field. In your opinion, I guess this is for all three of us, Shane, me, and Mike. In your opinion, is Disney a buy right now? Should you buy Disney? What do you think, Shane? Should you buy Disney? Call your broker. Huh? Call your broker and buy it? What do you think? No, I can't say that, so call your broker. Right. None of us can say. Tom, you're the only one that I think can say it, probably, right? I'm the only one that can say it, yeah. Well, it's already pretty high priced as it is, Everything's expensive. It depends on your portfolio, what kind of money you have. I'm showing a price-to-earnings ratio of 23.74. Average for a stock of this kind at best might be 18. It's more expensive than average. About the norm, yeah. But you buy these things on future earnings. That's why we do things. So if you're a believer, it's not going anywhere. I think that's true. Pays a dividend. I don't have that in front of me, but it's a small dividend, isn't it, Shane? Yeah, it's not 1.2%. Yeah, 1.2%. Yeah. But I would you can't do two things. You can't give a price and say when it'll get there. Yeah. But at 148, I see Disney going to $300. Yeah. Okay. Well, I would tend to agree with Shane. I don't think it's going to be immediate because. One thing, the networks aren't going to go silently into the night. They're going to battle this. And you're probably looking at, it might be 300 in 5 years? No, they hit 100 million subscribers. No, I'm at the stock price. That's what I'm talking about. Yeah. They hit 100 million subscribers, it'll be over $200. When they hit 200 million subscribers, it'll be over $300. Okay. Just from the cash flow. Okay. All right. We've got a caller waiting on the line, Shane, but I've got to take a quick break. We'll be right back with Mike McCormick and Shane and myself right after this.
All right, welcome back. 3 minutes left in this hour. We got several questions to get to Mike.
Lightning round. Yeah. Let's go.
Why should I use a financial advisor instead of just going with an index fund?
You'll know when you need one.
Yeah, I guess.
Next one.
Hey, Shane, do you suppose Elmer Fudd will be shooting them wascally wabbits on the new Disney thing, or will he be disarmed?
No, but we'll have the Roadrunner back.
You think he'll have the Roadrunner back?
Beep, beep.
All right. What about a free market approach to interest rates? Yeesh.
In some ways, we do. The overnight rates, formerly known as LIBOR, now some new acronym, is an auction-generated rate that, of course, the backstop is the Fed, so everything's anchored to that. Mm-hmm. We're a long ways away from that. That's a huge academic problem. The long end of the curve is a pure auction, and so in some ways we are there, and in important ways we're not.
Yeah. Will the December 15th tariffs affect the markets?
Yes, but we won't notice it.
Okay.
Again, I only got it. There'll be other news that either they got postponed, watered down. We won't know the impact. There'll be a glass half full. Yeah, but we're getting our soybeans sold here or whatever.
Okay. Well, I think we've got all of our text questions answered, Mike. So
and to the first one about the financial advisor and the index funds. You know, I'm working on a pamphlet because it's not enough material for a book. But if you are employed and not owning your own business and have a simple financial life, you probably don't need a financial advisor, at least during the savings and growth period. So there's a lot of good resources out there. But at the same time, just because I can change my own oil, I sure don't want to. I've had too many, you get the bloody knuckle from the thread slipping and then the oil's in it and then it won't heal up, I've had enough of that.
Yeah. Amen to that. All right, Mike, thanks very much. Tell them again how to get a hold of you.
Yeah, first of all, there's great advisors in this town. So talk to your CPA about one that might be a right fit for you. If you want me to try and pair you up with somebody, I'm happy to at 522-3890.
All right.
Merry Christmas, Mikey.
You too, Shane.